Welcome to the Power Forward Pod, hosted by the Power Forward Group Financial Advisory Team. I'm Ruben Lavavi, founder of PFG. In addition to our own Michael Day, we're honored to be joined on this episode by Rashaun Williams. Rashaun's a successful venture capitalist, Atlanta Falcons limited partner, and perhaps we're all known best from his role on ABC Shark Tank.
In this episode, we talk about Rashaun's background, how growing up on the south side of Chicago really shaped who he is today, and how he thinks about finances. We're also going to talk about how he evaluates deals in the VC world and in Shark Tank. Rashaun then shares insights on his new venture he started with Mark Cuban, Harbinger Sports Partners, how it came to be, and really the future ownership of professional sports teams.
You're not going to want to miss this episode. Welcome to the pod, Rashaun Williams. When I hear the word shark, especially when my wife hears the word shark, like she's afraid to go in the ocean, right? So when I hear the word shark, I'm like, all right, that guy can make decisions. Like he's all over. When you hear the word shark, what does it mean?
You know, being in the ocean is safer than being on Shark Tank, probably. But the best example I can give you is you think it's safe to pitch a room full of 6 people who are entrepreneurs and wealthy people about your idea. Be prepared to get your head chopped off. Like, VCs, we can hide behind pitch decks and emails and stuff. But when you're in person with someone and they see your face and you get to confront them if you think they're lying, I mean, to me, that's what Shark Tank is about. It's about being confronted on lies, and everyone lies, and getting instant feedback. And it goes the other way too. Like if you invest in someone, and I've done 180 investments and had over 50 exits, I've never seen the face of someone after I invested in their company until Shark Tank.
Right, because you're looking at a deck and you're not.
It's a term sheet. They accept it. You get an email. You have a closing call with attorneys. It's always a call. It's not a Zoom. On Shark Tank, people are crying in front of you, and it reminds you the personal side of entrepreneurship. It's like these are people's dreams that you're either crushing or you're helping them achieve them.
Well, even from where you're sitting, I find that naturally the easiest answer is yes. The hardest answer is no, right? We're all wired to say yes, right? And that's a beautiful thing about humanity. What would you say like the ratio is in terms of how many yeses you give to no's just in your history, your career, not even Shark Tank?
Well, we come from different backgrounds. I'm from the south side of Chicago, so I start with no. I came into this industry with trust issues already.
Okay, day one.
Yeah, from day one. And I'm investing my family's money. This is my hard-earned after-tax money. So I'm starting with a no. And I would say probably 99.9% of people that I see that pitch me, Shark Tank or not, it's no. And I get to yes by putting people through what I call the FIT test, F-I-T-T.
Okay.
And I'm looking at the founder's background. I'm looking for people who have integrity. I'm also looking to see what team they've been able to assemble around them and what traction they've been able to accomplish with that team and with that founder. The integrity part is, I wish I can bold it and highlight it. It's the most important part, actually, because there's so many scammers now.
Right.
Too many scammers. You don't know on Shark Tank anything about the person coming out there. So you don't know if they just scammed 5 other people. You hope the producers have done checks. Right. But in the real world, so many people can just change their name and create an Instagram account. They're being sued by 8 other people for money laundering and fraud, and they've been banned from the securities industries. And then they come to you with an AI idea,
right,
that you don't know that they just got sued by 5 other guys. So I find that people have to earn a yes from me, and they earn it faster if they pass the FIT test.
So it's F-I-T-T.
F-I-T-T.
So I love that because I think everybody's their money story, right? It's like where you come from is how you think about money. It's how you think about investing. It's how you think about all that. And you really have to figure out the strengths of your money story and kind of where your blind spots exist just because they're inherently there. And we think about that in the sports space all the time. But just going back to your history in terms of how you got into the money world, right? So you come from the south side of Chicago. Would you say your family was thinking about finances growing up, or was that
thinking about it
came up
nonstop because we didn't have it?
Right. So thinking about it in a very real way, right?
Oh my God. Yeah. Just thirsty for any knowledge or information that would lead to money. My mom was on welfare and my dad was a drug addict. And the people who were successful in our neighborhood were drug dealers. The people who were successful that weren't drug dealers moved out of our neighborhood. So there was this kind of desert of opportunity in this area. And I'll never forget, I could see the Sears Tower from my house, and it was 80 something blocks south, north of me. And I kept thinking, how are these people 80 blocks away living the American dream, making these millions?
Literally live on top of the world.
On top of the world. And here we are with no car, no heat in the wintertime, running an extension cord. Imagine this window having an extension cord through it so you can warm up a hot plate or have a heater in the room so you can take a hot bath, all of these different things. So that pain and that struggle really made me curious how money worked. So when I went to Morehouse and later went to actually work in the Sears Tower at Goldman Sachs, I was able to approach it from a very different perspective of desperation.
Got it.
I need this or I'm going to go back to being cold on the South Side. So I treated it like it was a passion, but it came from a pain.
Yeah. So you hit the top. You literally hit the pinnacle of what you saw, right?
Yep.
So you hit the pinnacle of Sears Tower. Which some people call it the glass ceiling, different versions in events, right? I want to get to how you broke out of that because in some ways you kind of took the paradigm of you broke into the wealth management world, and then you kind of exploded out of the wealth management world, right? And you created your own version, which I want to get to today in terms of the fund that you guys are beginning with Mark Cuban. But like, were you happy when you hit the top?
You know, I was happy to not be struggling financially anymore. There was a new set of issues that presented themselves to me, and it was Wall Street and being around. It was the first time I was actually ever around any white people. I'm from South Side of Chicago. It was all black. I went to Morehouse, all black. So I was not only around wealthy people for the first time, but also around non-black people for the first time. And I had to quickly get up to speed on all of those factors all at once. But there was one thing that really helped me, and the language of finance and investing, it's a very results-oriented world. So
Sure.
here I am coming in the youngest guy, but I realized that people respected people who helped them make money. And I wanted to help people make money more than everyone else because I knew what was on the other side of the trade if I got fired, right?
Right.
So once I figured out the rules, and the rules for me were very simple: learn as much as you can, as quickly as you can, find ways to help people make money, and get people to like you. I said, if I could do those three things in finance, I'm pretty sure I can get promoted and get paid here. And those were the only three things I focused on every single day. And that's how I was able to kind of get above my circumstances.
So, Mikey, you come from a little bit of a different world, right? I come from a little bit different world. We all have our own backgrounds that brought us into this, but you also, like, every time I speak to you, the thing that tends to motivate you is like you hate when people waste that like couple of cents at the end of the dollar. Like every dollar's got to be used. Mikey's like every credit card point, he's figured out the system how to get it, and it drives him nuts when successful people aren't doing it. Forget about people who need a little bit more help. How did that, like, where'd that come from for you?
I think just seeing the community we're from, me and Ruben, similar community, how people just waste money on things without realizing. I think that's just where it came from. And there's so much value that you can get out of everything, especially travel. It's something I love. Ruben just spoke about it. People are spending money. They're using their credit card points. Dave Portner had an example. He went to CVS. It showed 45 million Amex points.
Oh
like when I saw that, I was like, oh, that feels
nuts.
You could go to Maldives 50 times. You can go wherever you want. And just seeing that makes me want to like help him use the points, maximize. Even though these people are all wealthy, that's what drives me.
Right. Yeah. For me, what it was is my grandparents are both Holocaust survivors, lost their whole families, and they came here post the Holocaust. They came to America. They couldn't speak the language. They had no family, and they wanted to rebuild. And what I love about this country, it's got a ton of problems. Everywhere has problems, right? It's very easy to focus on what the problems are, but like where you came from, right? You were able to find the breaks and make your own breaks, and the system allowed for that to some degree. It's not an easy system, but you're able to operate the system. I love that they were able to create, generational. I'm a third generational successful family. That when we think about success, it's how do we utilize that money that we're able to create to keep family together, to have those family experiences, to have those travel experiences, because money without experiences is it's probably psychology solved.
Right.
It might be the Elon Musk world, a world where I got to be top of the triangle all the time. But you hit the top of the tower, right? And then you succeeded. You solved your own success, and you're solving for other people's issues. And you said, I want to do something else.
Mm-hmm.
Why?
Well, it was two things I wanted to do. I read this book by Jim Collins called Good to Great about 30 years ago now. And he also wrote Built to Last. And one of the concepts that I learned from him was this concept of the magnificence of the A-N-D. I actually wanted to be a school teacher when I was in elementary school and high school. They still make a lot of money. I also wanted to be an entrepreneur.
Right.
But here I am on Wall Street. So what should I do? This or that? So I actually started doing all of those things. So I started teaching financial literacy while I was on Wall Street. That's how I started mentoring all of these athletes and entertainers. Teaching financial literacy. I teach kids, I teach adults, and I teach mostly people who are first generation wealth curious or wealthy, right? First generation rich. Then I wanted to start my own business. So while I was on Wall Street, I was thinking, how do I buy businesses? How do I start businesses? I started my own venture capital fund. I started my own private equity fund. And I was doing all of this stuff while I was still on Wall Street. But I was really inspired by what Jim Collins said about like I spent less time playing video games. I spent less time going to the clubs, but I spent more time doing the things that I actually really wanted to do instead of what I just needed to do to pay my bills. But that's how I've been building this network for 25 years of professional athletes who didn't get the educational training that I got at Goldman Sachs,
Yeah.
whose parents never explained to them about credit and all of these basic concepts. That I sat next to people who, by the time they turned 18, they were added to their parents' Amex and they had an 850 credit score.
Right.
Where the guys that I grew up with, credit scores were 350 because the mom put, the light bill in their name and never paid the bill when they were 7 years old, right?
Yeah.
Which is like my actual story. So that's why I started to diversify and do other things. And not until I was making more money doing those things than I was working on Wall Street. That's the only reason I left.
Right. Better opportunity.
A better opportunity turned that passion, something I was doing for free, into something that I now do for a fee. Private equity.
I mean, the financial literacy side of it always has shocked me. Like we work with corporate attorneys, top 100 law firms in America. They call it big law, so to speak, right? And they've gone to the best Ivy League schools. They've had amazing, the best education money can buy, so to speak, right? And I'll tell you, we also work with some athletes, and I wouldn't say the financial literacy and education is better on the big law side than it is on the athlete side. The big differential is the big law side has more time to make mistakes. They come oftentimes from a scenario where the credit's there, right? They're not building from zero, right? And they have these long lasting careers. So if you're 18, 19, 20, 21, 23, making a lot of money, you will make mistakes. That's part of your 20s, right? Your 20s for making mistakes. Your 30s is for figuring out. Your 40s is for making real money, a lot of people say, right? Some version of that, right? And they have time. But the issue a lot of our athletes face, and it's coming out more with NIL even now today, is even if you're a professional successful athlete, right? 10-year career in the NBA is great. In the NFL, it's amazing, right? And then what happens afterwards? So if you make those mistakes while that income's coming in and you don't have that financial literacy and the financial background, you're left with nothing.
Yep.
Right. And now we have kids getting paid earlier and younger, which they should be. But who's there to support that? So we all consume that. That's why the world of sports is worth so much. And you kind of, we'll talk about sports 1.0 and 2.0, which I know you love to talk about. So we're all consuming that. We're putting more and more money in sports day to day as consumers. How do we take care of the athletes and the people the laborers, so to speak?
So the good news is you'll see this situation improve every single year from now going forward for a couple of reasons. One, you just mentioned they're getting money earlier.
Yeah.
So now they make mistakes at 17. So by the time they're 22, they're like, I'm not making that same mistake.
That's math for you.
Right. The second thing is they're making so much money now that the chances that they'll go broke just starts to get slimmer and slimmer. Right. Back in the day, the average career was 3 years. Guys made $5 million. Different situation.
Right.
Guys making $100 million. You can still lose half of it and be okay. Right. But if you take a step back, I don't know anyone, and I'd be curious you guys' opinion about this, who still have money saved from their 20s. I don't care how much money you make. Like, I'm talking about doctors, lawyers, everyone. Like, no one has money from their 20s. Like, your prefrontal cortex isn't even like fully developed enough yet to make good decisions, right? So everyone makes mistakes in their 20s, just like you said. But the second thing is, it's not just about being an athlete. It's about getting a bunch of money at the same time.
Yes.
Lottery winners,
Yes.
like anybody, people who inherit money from rich parents, like they all blow it. And it's just because of how money works, right? People don't understand it's a slow and steady race. It's a combination of what you spend and what you earn. It's not one or the other.
Right.
It's the relationship between the two. People don't even understand what passive income is. So what I'm seeing is that there's a new generation of athletes like Larry Fitzgerald, like Thaddeus Young, like Malcolm Jenkins.
Yeah.
And these guys, you wouldn't even know that they play pro sports if you had a conversation with them today.
Right.
These are all retired guys that if you sat down with them, you would think that they worked on Wall Street or in private equity and they have a portfolio that's like a venture capital firm.
Jamal Mashburn's like that. It's yeah.
Mashburn, I don't even bring him up because he's so far removed from being an athlete.
Yep.
He's such a good business guy. I'm like, dude, you have to prove to me that you actually played basketball before. But that's Mashburn. But yet that's the new generation of guys. And you're not going to see those same mistakes over and over and over because now in our culture, it's actually cool to be a businessman.
Right.
Remember the bling bling era
Uh-huh.
with the big long t-shirts and the big
Yes,
chains
man.
and the
Gundy
spending
Brills,
reels?
all that, yeah.
That was cool then. That's what everyone wanted. What's cool now? Nas has a venture capital firm and being on a cap table and
I'm a
being an
brand.
entrepreneur, right? So now that is cool in our community, the kids, the young guys, they want it. So we get a lot of phone calls from young guys that are like, hey, I want to start my venture capital firm. I'm like, dude, you're 17. Like, go play some video games.
Right. You
Get-
still you got to make mistakes then.
But the older guys are figuring it out and they have enough money. And now they're hanging with people like us who were finance nerds that were never cool enough to hang with these guys in the past because they really want to build out their family offices and their wealth and alternative investments.
You may have just called me cool. I'm not sure. Mikey's not me. Okay, so you guys are launching the fund. You're launching a fund, Mark Cuban and a bunch of other super impressive people. Tell us about the fund. Tell us about Sports 1.0, 2.0.
Yeah.
Give us a background.
So I had a VC fund and about 90, I'm the worst investor from a personal standpoint because and a lot of people who are entrepreneurs and have really good returns are too highly concentrated in one area.
Right.
So from that perspective, from a diversification standpoint, I'm the worst. And I know Warren Buffett and these guys say diversification is
Cheapest form of risk management.
exactly right. So like when you're in that world and you're making money off Coinbase and Robinhood and Dropbox and Lyft and Ring, you just want more of that.
Yep.
You're not thinking about other stuff like public equities. I'm like, why would I do that? I'm literally making 30% IRR in my VC portfolio, and I'm having IPOs every week until you're not having them anymore. Right. So this whole thing started because the conversions of two things. The first thing was I had a very solid strategy of buying illiquid minority stakes of tech companies from former employees, founders, and VCs. Spotify, DocuSign, Airbnb, Pinterest, DraftKings, and we were killing it doing that 10 years ago. And the secondary...
They were selling to what? Create liquidity?
Yeah,
themselves?
Exactly. These guys wanted liquidity. The IPO was still 5 years away.
Right.
The VC was on year 9 of a 10-year fund. They needed liquidity. The employee doesn't even work there anymore. Right. It's expiring stock options, right? The founder is worth $30 million on paper. He's getting paid $300,000 a year.
Right.
So we're giving liquidity to these guys. And I would put those shares in SPVs, and then I would sell the entire SPV to another investor before the IPO, before M&A. I didn't want to take the lockup period risk. So that strategy worked over and over and over. So I kept building my personal portfolio that way. At the same time, I remember in 2000 and 2001, what happened with the tech bubble, what happened with 9/11.
What could happen?
I remember in 2008, I was at Wachovia, the 4th largest bank in the country at the time, 8th largest in the world.
They don't exist.
And I had a bunch of real estate investments, and I thought I was hedged. I'm working at Wachovia. I'm getting paid in stock options. I have real estate portfolio. I'm invested in equities. Everything went down at the same time. So I said, I can't stomach another downturn where I built all of this wealth and I'm going to see it get cut in half at the knees anymore. What can I invest in that is non-correlated to equities? It was supposed to be gold. It was supposed to be crypto. It was supposed to be all of these things.
Right.
And then I looked right in front of me and here it was, professional sports teams. And it hit me. So I reached out to Cuban and others and I said, hey, can you tell me in 2000 and 2001 when the markets dropped, if NBA team values drop, if NFL team values drop? In 2008, did they drop?
Nope.
Right? And explain to me why that is the case. So once they explained it to me, I said, wow, here's an asset class that for the first time in 100 years is actually opening up to private equity guys like me and non-billionaires like me. And at the same time, I'm really good at getting into these illiquid assets. I have a whole strategy. I did it in tech. And sports today, from a liquidity standpoint, is where tech was 10 years ago. So I said, wow, I have this idea that no one else is doing, creating a sports fund that's owned and operated solely by team owners and operators. So I said, who's the best team owner or operator I know in the NBA? Mark Cuban. Mark Cuban came in, managing partner. Who's the best owner and operator I know in football? Steve Cannon. Steve Cannon was the CEO of Arthur Blank Sports. So the Atlanta Falcons, Atlanta United FC, he built arguably the best stadium in the country, Mercedes-Benz Stadium. And then who's the best owner operator in baseball? Jonathan Manor, former CFO for 14 years of Major League Baseball. Put the team together, added my liquidity solution to this illiquid asset class. And then we all sat at a table and I said, now guys, what is the most compelling reason why people should invest in the big 3 sports leagues today? And here's what all 3 of them say unanimously. Right now, we're at an inflection point in the big three. You can get the returns in the safest asset class in sports, the same or higher return than you can get in early and growth stage sports leagues. You don't have to take on more risk to get the types of returns today. And let me tell you why. The old model of sports ownership was sports 1.0, where you relied on the media rights.
Right.
Everyone got a big check from the league, media rights.
TV contracts.
That's right, from the TV contracts. The new model is the media rights, sure, you take that check, but now you build and own and operate all the real estate around the team locally. So that's called sports 2.0. To give you an example, the Atlanta Braves went from $264 million in revenue to $650 in 10 years when they moved from Turner Field to Cobb County.
Right.
And all they did was go from sports 1.0 to 2.0. They rented their field at Turner. They own their field in Cobb County. They own the parking lots, the movie theaters, the restaurants, the bars, commercial and residential real estate. They don't have to share any of that revenue from all of the non-sports stuff with the league or with the players. So it's higher margin business as well. If teams are trading at 10 times revenue, do the math. If you grow revenue from 300 million to 600 million, you just grew your valuation from 3 billion to 6 billion. Multiply that times 92 teams, because less than 20% of teams own and control their stadium, and 50% of every stadium needs to be replaced because it's older than 15 years.
Right.
So that's the opportunity for revenue growth in the future. And that's why a guy like Mark Cuban, who was a sports 1.0 owner, who sold his team 2 years ago, would start a private equity fund. And by the way, he sold his fund to sports 2.0 owners, these Las Vegas casino and real estate guys. What do you think they're going to do with that?
It's about it's about their China business. It's about their Vegas business.
That's right. And that you see it happening right before your eyes. No one's putting it together because in the owners' meetings, we're talking about it. But when Josh Harris bought the Commanders, it was like, you pay $6 billion for that team? What's the first announcement he made? New stadium.
Yep.
Every time you see someone buy a team, they're building a stadium. They don't do press releases on the real estate around it because they don't want people in their business, especially the players. But that's the move.
It's so true. You remember the days when they were begging like the local county or the local government for funds, and that was the big fight. Like, do we fund the stadium? Do we fund New Yankee Stadium?
Yep.
We're past that, right? There's
Yep.
so much private equity money now.
There's the desire for municipalities to finance stadiums for billionaires is dwindling, which creates an opportunity for private equity and for people who want to grow from sports 1.0 to 2.0 to buy and build their own stadium. And even in Atlanta with Mercedes-Benz Stadium, I mean, we're renting a stadium out every day but 6 days a year.
Yeah.
The Atlanta Hawks across the street from us, 40-something home games, 120 concerts in the same arena. So that's the model.
All right. So, Mikey, when we speak about like our individual investor clients, right, we think about diversification as your cheapest form of risk manager. What are we thinking about in terms of how to diversify portfolio? Is there a place for, is it private? Would you call it a private equity investment? Like what asset class would you call this?
It's definitely private equity. It's just like buyout funds in private equity, except I would say three main differences. One, the big three professional sports teams are local, legal monopolies. You don't have to worry about competition.
And you democratize them to some degree.
That is correct.
Individual investment.
That's correct. And number two, that non-correlated aspect to it, but it's also tax advantage. So buying the sports teams is a tax-free money bucket, Section 197, goodwill amortization and depreciation. And number three, very low leverage. Like if you invest in a buyout fund, they can throw 70, 80% leverage on it. The leagues cap leverage at 10 to 12% on these teams.
Yeah.
And these organizations have been around for 100 years. So these sports teams.
Well, that's the other piece of opportunity, and then we'll let you run, is that idea of, we spend a lot of time, my background was in estate planning attorney, spent a lot of time on how do we pass money from G1 to G2 to G3. And a lot of these teams were family-owned teams, right? We saw with the Lakers with the Bus family. It's, these families are really well off and done really well, but that provides an opportunity, right? Where's that opportunity for the private equity market? You see that opening.
So there's one control owner for every team.
Yep.
And there can be, let's say, up to 24 minority owners per team.
Yep.
Let's say on average, there's 10 to 20 owners per team, 92 teams in the big three. That's 1,000 to 2,000 guys and girls who own between 1% and 40% of a team. And guess what the average age of these guys? 75.
There you go.
So that's the supply. There's not enough private equity money out there to take advantage of that. A 10% check in a sports team is $500 million. How many guys you know are going to write a $500 million check with no control, no voting, no board in a sports team?
Nobody.
That's why private equity exists. So we have a great opportunity to not only write a check, but also do co-investments And it could be 4 private equity firms in the same deal, and it's still enough room.
Yeah. Well, I think to encapsulate all of it, to me, when I step back and look at what you've done, you've taken an old idea to an old business model and reinvented the whole structure of the whole thing. And that I think was where, to me, that's what 2.0 means, right? You've reinvented the wheel of 2 old classic things and brought them together through different.
That's why we named it Harbinger.
There we go.
What's to come in the future?
By the way, I didn't ask that. I was thinking that.
Yeah.
That's why I named it Harbinger. We're the next generation of sports investing.
Love it. Well, thank you so much for coming in today. Glad to have you in downtown Fidei.
Hey, there we go.
Looking forward to visiting you in Atlanta and looking forward to getting off the ground with Harbinger.
Absolutely. Thank you for having me.